There we go. Okay. So this is part of the presentation for the CE credit. So we're going to go through it and then we're going to switch to another presentation as well. And this is simply going to be going over, the market, why and how do mortgage interest rates change, how the Fed impacts mortgage bond market, why it matters, and how to understand the economic reports. What's important about this is that the media is out there for entertainment, to get people to watch them. And so what they're going to show on the media is always going to paint a doom and gloom picture, because that's what attracts audience. Unfortunately, good isn't really attracted. It's going to come from, going over the things that are wrong. And so having the education and the information to be able to talk with your clients that are stats and that are statistical is going to show that you're the advisor, that you're the one that's going to be able to go through all the information. So don't get too caught up in understanding this fully. Really, it's just understanding the concepts of it so that you can have a conversation with your clients. So what we're looking at here is how mortgage money flows. To understand how mortgage interest rates how they're derived, you need to understand how it flows. So you have bond investors, which are the ones that are going to be buying what's called mortgage-backed securities. So mortgages are bundled up. So when someone comes to us, the lender, they're going to get a mortgage, and then we sell those, if you will, to their investors of Fannie Mae and Freddie Mac, mainly, are the big investors for like conventional financing. So those are then going to be sold on what's called the secondary market, which is known as mortgage-backed securities. They're securitized and bundled and then sold to bond investors. So whenever you have this flow chain of money, a lot of people will say, well, if you know the bond market's only, at 3%, why are interest rates 4.5%? Well, everybody's taking a cut of the pie as it goes through, right? So you start with the lender who has to charge a higher premium, because then then it goes to Freddie Mac, Fannie Mae, who charges a premium, and then it's sold on the bond market. In order to get investors to buy it on the bond market, it has to be attractive and make sense financially. So it goes through a flow chain as far as money charts. So this is a great example here. So it shows, the borrower may get a 4% rate, then the mortgage company is taking a 0.5 point, then the investor, Freddie Mac or Fannie Mae, is taking a 0.5 point, and then when it gets to the bond market, it's depending on whatever the bond market is doing, what it will sell for, let's say 3%. So in reverse, if the bond market is having to pay 4% to attract investors, that means the rate's going to be passed on to the consumer, right? So that's why when you look at the economic reports and you look at the markets, it's what drives mortgage interest rates. So it's always funny when people are like, why are the lenders increasing rates? No, it's all a matter of what investors are willing to pay for these securitized bundles, which is where it's derived from. So I just actually took this yesterday, so we have updated information in here, because I think it's crazy to look at these numbers. This is what's called mortgage-backed securities. So this is where we're tracking mortgage interest rates. This is what I'm looking at all day long to see what's going on with the rate market. And on mortgage-backed securities, which is again where they're securitized and sold and bundled to investors, right? You can see back here in 2020, interest rates before COVID-ish was around in the 4% range, right? And then through COVID, we had all of the shutdowns and everything that happened. And then you can see rates went down to about 3.25. And then you see here, just this year fall. So what you're looking at here is that if you look at the top of the range, so you're going to look at the top of the chart, when interest rates or when the market, when the line is up top, that means interest rates are lower. When we see them down here, that means mortgage interest rates are higher. So you can see they just plummeted. So they went from a 3.25 range down to now we're in the almost high fives in the 30-year fixed rate mortgage range where we are right now. Why is that? So having that conversation with your clients is important. I mean, how many of you guys have had clients that you worked with 3 months ago and we were in the 3% ranges, and today now, they're in the 5% ranges, and a lot of them can't even qualify or can't afford the mortgage anymore. I mean, I have so many that I had to keep calling, and it was such a dramatic shift. So it's literally every week I'm having to go and be like, sorry, you qualify for 10,000 less. Sorry, you qualify for, as a pattern. And it can be very frustrating to the consumer, but it's our job to make sure they're educated to understand the market. So knowing how all this works is going to be super important. So back when we had the crash, right, 2008, which you can see here in the illustration, we had the market crash, which was, primarily because there was oversupply, there was too many homes, and there were bad loans. They were giving out adjustable rate mortgages to people that didn't even have to supply income, and there were just, bad loans that were made. So whenever something like that happens, the government has to come in and save the day, right? So they're like, oh my gosh, what are we going to do to re-stimulate the economy? So what they started doing is they started buying mortgage bonds to make them more attractive, to get investors to buy mortgage bonds, right? So they're kind of playing the market, if you will, to make them more attractive, to get investors to feel safe to buy them too. So they hold over 2 trillion. I mean, we're actually close to 3 trillion in mortgage bonds, which is why interest rates stayed as low as they did for as long as they did. So understanding that a decade of low interest rates that we had was because the feds were involved with buying markets. Why does that matter today? Well, because the feds are talking, saying that they're going to release the balance sheet, which means that they're not going to keep reinvesting the money that they're getting from these bonds that they bought. They're going to stop. They're going to let them sell off. So what does that do to investors? Now there's panic. It's like, okay, well, what is that going to do to the market? So if you were an investor in this market, you would be panicked too. You're like, oh, do I just get out now? Is it going to plummet? What's going to happen? That's what we're seeing. So investors are very scared. Every time the Fed say they're going to either quit buying bond market or they're going to increase the Fed rate, it's all risk tolerance for investors. So that's why there's so much volatility, is every report can conflict the previous report right now. And then you shifted COVID into it, which was a lot of uncertainty. And so there was just a lot of unknown that was in there. So with them having over 2 trillion in the mortgage bonds, they put all that money back into the economy, which now they're saying, oh, we're going to hold. So now a lot of investors are like, scared, is the market going to crash? And so if they pull their money out, well, now you have to pay higher to get them to invest in buying these mortgage-backed securities, which, remember our flow chart? So if they're going to have to be paid more, what does that do to interest rates? Now interest rates have to go up to be able to get the investors to buy the mortgage-backed securities so that we can continue giving mortgages and sell them. Make sense? So it's a whole circle that you got to understand so that you can make sure that we can articulate this. So why else does the economy matter? So it's all about risk tolerance and safety. So whenever we have bad news in the economy, which COVID was bad news, you're going to see that there's higher risk. And so you'll see them shifting. Investors are going to shift from bonds to other investments because of the risk tolerance. Now, we all know the more risk that you take, the bigger return that you're going to get. But when it comes to a long-term sustainable asset, with investors looking at it, they're willing to take a certain amount of risk. But when they think that risk is going to be greater than the return, they're going to shift in things that are more stable, such as like a bond loan. The same is true with the opposite when we have good news. But more buyers than sellers obviously equal higher price too. So when the prices go up, you see the rate go down. And then when there's good news, it's the opposite. So whenever there's good news, now you see people move from the bond market, which now shifts to the stock market, which is then we see better interest rates. So it's all depending on where the investors are going that's going to determine where we have the price changes. So good news in the economy means that rates go up, which is funny to think of it that way. But if people are doing good, you could charge more, really. I mean, at the end of the day, you kind of look at it that way to remember. And then bad news, rates go down. So why is that important today? We're going to look at 3 economic reports that play a huge role in the market today. The first one is jobs reports. Do any of you follow the market updates and the reports at all? I know some of you are on my Monday updates that you probably see that basic kind of stuff, but it's really important for real estate. And a lot of people don't realize how these reports make so much sense. So now when you see, people talking about these reports, you're like, oh, okay, that makes sense of why we're talking about it. Really positive jobs reports, you can see what it does here: wage inflation, economic activity growing, consumer confidence, investors sell mortgage-backed securities, because again, a good economy. A good job report means that the economy is doing well. So again, the rates go up, price comes down. And then 2 jobs reports that we're watching is every single Thursday, we get the initial jobs claims and then the non-farm payroll. So you might start seeing a trend where mortgage interest rates change after a report comes out. And it's because, did that report come in favor or not in favor of interest rates and the market investors? The second one is really important: gross domestic product, which is the GDP, which really just tracks how people are spending money. So a recession indicator is when you see the GDP go down for 2 quarters in a row, meaning people are not spending as much money, which is where we're going to get to on our other market update. So we're tracking the GDP, and then obviously inflation. How many of you have heard inflation nonstop right now? I mean, it's just all over. And when you hear it from the media, you're only hearing the negative side to it, which inflation is negative for the economy as a whole, which is why we're dealing with what we are today. But to give it perspective, you can see here, I just did a calculator yesterday. For $100 back in 2008 is only worth $86 today. That's what inflation does. And so where that becomes a big concern for average day consumer is these people, the average consumer has $30,000 in credit card debts. Why do I say credit card debt specifically? Well, because those are adjustable rate mortgages, right? So there's no way for them to really know what they need to account for in those payments. And most of them are just paying minimum payments. So they come to us and they want to purchase a home and they have these credit card payments. They're only making minimum payments. And now they're having to go into a housing payment, especially with where rates are today, that's way beyond what they were even paying for rent. What's their contingency plan to be able to pay off these credit cards? Well, a lot of these people purchased homes from us in the last year, and they're now seeing it with high inflation because these payments have now gone up. Their $100 is not going as far. So where they may have been able to make the minimum payments in their mortgage before, they're starting to have trouble. So this is a concern. It definitely is going to impact people that have been there, and making sure that, you know, they truly qualify is important, but also being an advisor to give them more information of ways that they can help combat that's important too. But this is why there's such a huge aggressiveness with the Fed now that they realize they screwed up. They should have took action way sooner than they did. And now they have to be super aggressive to curb inflation, because if they don't, what's going to happen? Employers, what's the first thing they do when they need to hedge their profit? Let go people, right? So they're going to let these people go. And then what happens with those people? Well, now they're no longer spending money into the market because they don't have money. So now if it's a continued cycle and that continues, that's what can lead to a crash, right? Because people, it's just a whole cumulative of what's happening. So the Feds know that, yes, we need to step in, we need to curb inflation, and we need to act fast in order for us to make sure that it doesn't end up somewhere really, really bad. So inflation, obviously with the bond market, if someone puts in money into the market a year ago, their return they're getting back is less because of inflation, meaning that $100 is now only $86 on a return. So high inflation means high mortgage rates. So as long as you keep hearing inflation, that means mortgage rates are going to continue to rise. So until the Feds can get inflation under control and at least see that we're combating it, it doesn't necessarily have to turn right away, but at least see combating it, we're going to see interest rates continue to rise, which is where we're at right now. We're still seeing them rise in the market. So inflation, how is it measured? So whenever you hear the media say CPI report, that's the main one that people are following, is going to be the CPI indicator. And that's really just a measure of how is inflation, how is it doing? So when you hear them say we're at the highest that we've been in 41 years, they're measuring that. So they're looking past years, how much did the dollar deflate, and being able to see where we're at with inflation. So you could see here, this is kind of a history of long-term government securities of interest rates from 1799. It's crazy to look at this graph. And I think it puts in perspective for clients too, when you show them the rates. But you can see back in, the 1800s, and then you can see kind of, they went down in the 50s, and then you could see that, they went up in the 80s and they've come back down. So interest rates are always going to fluctuate. You're always going to see it, but the highest rates came when there was inflation. So all of these peaks that you're seeing was when we were in high inflationary periods. So it is a direct indicator of what mortgage interest rates are going to do. So understanding where the market is and understanding, are rates going to go up? Are they going to go down? Are they going to stay the same? Is really what our clients are wanting to know, and what we need to educate them on so that they can have all the information and make a good decision. Now, the true reality is a lot of people shouldn't buy right now because they can't afford it. Not because they shouldn't buy that it's a good investment, but if they do have a ton of debt and now they take on a higher mortgage payment, even though it is a good investment and they will get a great rate of return on it, they need to make sure that they can afford their payments, especially in high inflationary periods. So although we want to get people in homes and we want them to buy, we also need to look out for their best interest too and make sure that they're educated on it. So we're really playing that field of, being an educator and a salesperson, where of course we want them to invest because we all know that it is the greatest investment that you can make, and they will get a rate of return at some point, but also making sure that they can afford it as well. So I do send out my market update that hopefully you guys are getting a copy of. If you're not, let me know and I can send it out. But now I want to go into the practical, I call it, application of going over information with your clients. So this is the video, and this is the handout that you have. And this is the video that I can send out to you if you want it for your clients, that will educate them on kind of where we're at, where we're going, especially for people. I know I have a lot of clients that went from that 3% range to the 5% range, and it was a big payment jump. And so having this conversation with them just to educate them, say, here's where we're at, here's where we're going, and does it make sense for you? Some of my clients are on a home buying plan. So if I have a client and they don't qualify right now, or they're not comfortable with the payment, or it's not something they can afford, I have them on a financial wealth management course. Like, how can you save money? So these are other things that we need to be looking at too, is if it doesn't fit, we educate them. If it doesn't fit, how do we stay in front of them and help better their situation with finances and wealth, so that when the recession hits, which we're going to talk about here in a minute, and rates come back down, they're ready to go. So it is an opportunity, and it's on us to be able to explain that to the client and say, hey, look, we're in a great opportunity for you right now, one way or another. Whether you buy or not, you have a great opportunity to be able to invest and buy in today's market at the price that it is today, or get yourself in a great position to where prices or interest rates do come down, that you're able to buy. So this we already talked about, which is the interest rate market. So again, red on this chart is a per day snapshot. So this is what I look at every single day. So this is a per day snapshot that says, based on today, when the market closed, where were we? So if you see the green, that means interest rates were better that day. If you see the red, it means interest rates closed worse that day. If we're up here again, it's better interest rates. If we're down here, it's better, or it's worse interest rates. Up here is better rates. So you could see just from January, and you can see the line. If I were to draw a line from here, you would see the line. The bad news is where we are with this red right here, we're continuing to decline, which means that we have what's called floors and ceilings of support to manage where we would probably go with rates. And we just today broke through another floor. So that means that we're going to continue to see rates get worse, not better right now. So be prepared when you have those conversations with clients to explain to them, yes, rates have changed a lot. Here's where we're at. Here's what the market means. This is really important to understand too, when you're talking about this, because really what we're going to talk about in this presentation right here is the direct impact to our clients. Inflation, recession, what does that mean and how does it work? So if we look at all the patterns of the different presidents, right? Every president has their way that they deal with inflation. So what this chart is showing you each pattern of the president. So you could see, if we look at Burns, the inflation at that time was 7 to 14%. Mortgage rates were between 12 and 18%. And so of course they said, okay, inflation's higher, we need to curb inflation. So you can see the mortgage interest rates went up to 18 to 12%. The Fed fund rate, look at that, 11 to 20%. Anybody know what the Fed fund rate is right now? It's about a quarter. They call it a quarter. So 0.25. So you can see the Feds, they reacted when inflation got high. He reacted and said, okay, we need to increase the Fed fund rate, which it made the response was interest rates went up again, 12 to 18%. And then the consequences is it hit a recession. So whenever we have high inflation and the Fed has to step in and they have to, they increase the Fed fund rate, that is what curbs inflation. That's why they're doing it, which means that it's going to help us not devalue our dollar. It's going to give us strength again. So when that happens, usually 1 to 3 years after, we hit a recession. So what that means again is that the GDP for 2 quarters or more, and some other stats we're going to go over today, people aren't spending money. So now they need to re-stimulate the economy. So right now they're trying to slow the economy. Has anyone tried to buy an off-road vehicle or a trailer or a car? It is ridiculous how much these things cost now, because inflation, they've all increased prices. So they need to curb that. They need to make things more affordable. So when we hit the recession, which is where we are going right now, and I'm going to show you the stats to prove it in the next 1 to 3 years, you're going to see that housing stays stable or continues to increase. So it's not a bubble, but interest rates come back down. So you can see the trend here in every single one. With the inflation, they increase the Fed fund rate, recession. Inflation, they increase the Fed fund rate, inflation, every single time, which is where we're at right now. History repeats itself. That's what it's doing. So this is a 10-year yield proxy for mortgage rates. We talked earlier about the sell-offs of mortgage. So remember I said the Fed stepped in after 2008 and started buying all these bonds, and they have over $2 trillion in bonds. If you look at all of this here in the accounts since 2015, you could see the Fed's hiked rates, and then you could see that the prices fell. And then you could see that they wait again and prices fell. So every time the Fed step in and either hike rates or they do anything with the balance sheet, it's a major change in the market. So the biggest one I want to show you here, though, is the Fed's slow pace of runoff. That's that balance sheet. So back in 2009, they attempted this before because they wanted to stabilize the market. They're like, okay, we're going to start backing off. Look what happened. Remember, that's when interest rates got worse again. So this is the 10-year. So it's the opposite. So when it goes down, it's actually higher rates, but rates got worse. And they said, oh, just kidding. We can't do that because it's hurting the market. We need to stimulate the market. So then they stopped the runoff, and look what happened. Rates started to stabilize again. And then of course we had the COVID shutdown that had the impact as well. So the Fed's even talking right now about doing the Fed hikes, and the runoff is what's causing our rates to go up. Mind you, we've had one actual Fed hike increase of a quarter point. So it's a big impact when we get these news updates of what they're doing. US Treasury spread, this is really important to kind of just look at. It's called yield conversion. And so when you're looking at these different time frames, if you will, for bonds, so you have like a 10-year bond, or you have a 1 year or a 3 year, that's how long you're going to have to hold the bond to get a rate of return as an investor. When they convert, that means that normally if you hold the bond for longer, you're going to get paid more because you're giving your money up, right? It's a long-term investment, so you're going to get paid more. That's not the case, which is a yield conversion, which means that when we see a yield conversion, meaning that you're going to get the same for a bond that's 1 year versus a bond that's 30 year, that's another indicator of a recession, which is where we are now. They actually did invert. You can see here, inversions lead to recession. So every single time that there was an inversion, it led to a recession. You can see the red is the recession every single time. Unemployment rates and recessions, another indicator that's leading us to a recession. And the reason I'm showing you these stats is it's one thing for us to tell our client, hey, rates are going to come back down because we're hitting a recession. Well, how do we know that? Is somebody just saying it? No, the numbers don't lie. If you look at all the stats and the graphs, it shows it. So unemployment, whenever it comes to its lowest and then it starts to peak back up, meaning that we're at really low unemployment. And then right now, because of inflation, what did I say? Companies are trying to protect their profit, which they're going to start laying off people. As soon as we start seeing that turn, which we're starting to see a little bit of it, is when it starts heading into a recession. Every single time you can see here. So the black or the dark blue lines is recessions. That's the tracking of every recession that we've had since the 50s. And you can see every single time that unemployment has gone back up, what did it? Recession, recession. So every single time. Now, the next question that we're going to get is, oh my God, we're going to hit a recession. What does that mean for the value of my home? So understanding this chart's really important too. So again, it's tracking recessions. So you can see the dark blue line is recession. Now look at through every single recession, what did housing do? The housing prices continue to rise. The only time that it didn't is when the market crashed in 2008, which again was because of oversupply. But look what happened. You can see that we've recovered because of that. And now we've continued to go through. So being able to tell people, look, your housing, based on all the stats and everything we're looking at, housing stays stable. So we don't anticipate that the values of the homes are going to come down. They're going to stabilize or continue to increase. But what's great is that during recessions, rates come down. So every single time housing has stayed stable, except for the one time in 2008, but interest rates drop. So think about that. If interest rates drop in the next 1 to 3 years, how many of the buyers that we have right now that can't afford to buy will be buying? A lot of them, right? That's why housing continues to stay stable or appreciates. So we may have a slight shift, for a little bit here where we'll see housing kind of stabilize. And then as soon as rates drop, it stimulates the buyers again, which stimulates the price of homes, right? Supply and demand. So when your clients are like, oh, I don't think housing is going to stay stable. Well, if you look at all the buyers that need to buy and how much housing we need and the lack of inventory, it's going to continue to stay stable. And this is why. Demographics. This is another really cool one. If you haven't looked at this, I was shocked when I learned about it the first time of how it can go back all the way back to our birth rates. But if you look back at our births, so births is going to determine how much housing is needed, right? Population control and population housing needed. So if we go back and look at the average buyers, a 33-year-old buyer, usually in the early 30s, or they're having their second child, is kind of what stimulates buying a home. So if we go back and look at that period of time, you can see here, the housing was or birth rates were really, really low because they legalized abortion, right? So it went down for that period of time. And then after that, you can see that birth rates went up. And you can see here that it was the highest birth rates that we had in this millennial decade for these 5 years. What does that mean in today's market? It's all about supply and demand, right? So all of these people right here for the 5 years are the ones in the market that need to buy right now. So we need housing. There's no denying that. All of these people need housing. We are short in housing. Well, you add COVID into it and you add the builder delays. And even if the builders wanted to build right now, they can't because they're all backlogged right now and their times are being pushed out because supply chain and all of that. So we have a crisis of needing more homes. The homes that are already built are occupied. And then the new home builds are really slow to be able to build. So there's going to continue to be an inventory shortage. So knowing this graph and being able to explain it to people, because they need to see the numbers and stats and know there really is, and it's going to continue. You can see they continue to increase all the way through. So we're going to continue to see strong housing. We're going to need it. And you can see the demographics here as far as the household growth. Again, you can see it continuing to grow. So all the way through 2021, 22, 23 are going to be the highest numbers of housing that we're going to need for people to be able to live. And then near record high purchase activity that we're seeing, low record activity. You can see that we went down a little bit, as we shift, and the now, record low inventory. We're at the lowest that it's ever been. You can see in 2022, we just don't have enough inventory to be able to house everybody that needs to be housed. So we can always go back to supply and demand, which is what we're looking at. And the peak, and where it shows if it's a strong housing inventory, is a matter of how much inventory is there. You can see when we peaked back before the crash, which is why I tell everybody the crash was simply because there was oversupply and bad loans. You could see it here. When we peaked in 2007, right before the crash, it was 3.7. A considered stable market for housing supply is 2.5. We're way down here. Huge shortage in inventory. Number of households. So you can see 116 for how many households back in 2007 versus today 129. Another graph that shows the shortage of inventory as well. But let's look at the numbers too. The affordability versus last year, because this is a big thing that and obviously rates are higher now, so I need to update this chart, but you got to take into account a couple different things. And this is where it gets really important to explain to our clients. So if we had our loan amount in 2021 was 400,000, rates were 3.375, and their payment would be 1768. So the appreciation went up 18%, which was a crazy huge amount of appreciation. And we'll hopefully see normal one digits going forward. But household income went up over 10.5%. So what does that mean? Because a lot of people are like, oh, I can't afford it. The prices are going higher. Well, how much more money are you making today than you did a year or 2 years ago? A lot more, because they're being paid more. So if it was 10.5% an increase in income, their income went from 9,000 to now 945. But you can see here, the payment went from 1768 to 2462. It went up 694. So they do make enough income. They've made more income in order for it to close the gap of how much higher their payment went. But they're not thinking about it that way. They're just thinking about the housing. It's like, well, how much more money are you making that you can now invest into the mortgage? So being able to show them that information is really important, because they just don't know that they can qualify. They don't know that they can afford it. I can't even tell you my conversations. I do a high trust consultation, an initial consultation with the client. And I always ask, what have you set aside to be able to budget for your mortgage payment? When I say mortgage payment, that includes property taxes and insurance. So like, I don't know. I'm like, well, what are you paying for rent right now? About $1,500. Okay, well, what do you think you're going to be comfortable paying for your mortgage? Do you have a budget set up? Have you looked at your expenses? They don't. I mean, even people that have a lot of money often don't even have a budget set up. So being able to explain to them, because they think in their mind, especially if they're being coached by their parents, depending on the decade their parents were raised in, they're being told they need 20% down, that their housing shouldn't exceed a certain amount, and it's a way different time. So making sure to go over that with them is important. This is what I'm going over with my clients right now, summarizing everything we just talked about in a conversation with the client to educate them to make the best decision. So we're looking at rates today, and this was when they're 4.99. So I explained to them, okay, if you purchased a home at 600,000 today at 4.99, your payment would be about 3288, including property taxes and insurance. But as we just discussed, interest rates are going to continue to go up through the end of the year. So what is that going to look like for you? And I'm doing this with them initially because rates are going higher, and I want them to be prepared when they're in contract to buy as well. But I show them what the affordability is. So now their 3288 payment now is 3440. So I show them that, hey, this is going to be the amount of affordability it's going to cost as you're looking for a home. But what if they go even higher? What does that look like? But this is the next bullet point that is really important to add to the consumer. After I've just explained to them inflation and recession, say, look, there's a really good opportunity for you here if you can afford the payment. Because when you're buying in today's market, you're buying the price of the home, right? So you're buying the 600,000. So if you buy a home today at 600,000, and let's say that you get a 4.99 rate and your payment's 3288, that's the price that you paid for the home. That doesn't change. As I just explained to you, we're heading to a recession where housing continues to stay stable, but rates drop down. What does that mean for you? That means in 1 to 3 years, I'm going to come back to you and say, hey, Sally, guess what? Great news. We're now an opportunity that you've not only gained appreciation in your home, but rates are back down. So we get to restructure your mortgage. So you don't have to pay more for the home when it's now going to be worth 660, 700,000. You bought it at 600,000. That doesn't change for you. So at 600,000, if rates were to come back down to 3.25, that 3288 payment now is only 2,800. That's the power of investing in a market where other people are pulling back if you could afford the payment. And explaining to them that's the cycle of mortgages, because if you wait and you purchase a home at 660 or 670,000 at a 3.2 rate, guess what? Your payment's still higher than the 2,800, and it's still higher than that 3288 that you would be paying today at the higher rate for the price today. Does that make sense? So making sure they have that information is important. Now I explained to them, look, you need to budget that 3288. That's not, I mean, it could be 1 year, it could be 3 years before we hit the recession and rates come back down. You need to be comfortable with the payment. But again, you have the opportunity to pay for the home today based on the price that it is today. And then I take it to them and I show them also, you know, what if they refinance at the, you know, if they have a loan right now, their current existing is a certain price versus what it will be, making sure that they understand, okay, here's your options. For somebody that, you know, qualified at 600,000, I actually just had a client this week, qualified through a different lender. They said, you know, you're no longer qualified at 600, actually I think it was 580. You're now qualified for 540 or something like that. And so the agent said, hey, just talk with my lender. I want you to understand what that means and all that. After talking with them, I was able to reinvest some of the money that he was putting for a down payment into paying off an auto loan so that he can qualify back up to 600,000 again. And his outgoing expense was still cheaper than what it would have been if he was qualified before. And what I mean by that is if somebody's putting more than the minimum down payment required, so 3% if they're a first-time home buyer unconventional, or 5% for FHA 3.5%. If they have more money to be able to invest into the down payment and closing costs, they're not even thinking about different strategies to help them save money until we hit that recessionary period where rates are going to come back down and they can get into a lower payment. But we look at the long strategy of it and say, okay, what if we pay off that auto loan? It saves you $400. So now you're putting less down on your mortgage, but you can afford the $400 higher payment on your mortgage because you no longer have the auto loan, and it's the same outgoing that you were going to, you know, the funds that you were going to pay for the purchase originally. But even beyond that is getting them in a mindset of investing and saving and strategy wealth. And depending on their level of understanding around investment, if they're a good investor, it's a different strategy. But for the standard homeowner, to say, hey, great news. In 1 to 3 years, when we're able to restructure your loan and refinance it, what if we put you in a 20-year? You're paying the same payment now that you know, now versus then in a 20 years. So not only did you pay off all your debt, you're now paying off in 20 years. So it's going beyond and looking at the wealth opportunities, but also looking at the strategies so that they understand this market, because they just don't. You know, that's what we're here to do, is to make sure we're having those conversations. And that's why I'm really important about giving you guys the education and information, because a lot of times they may not get to me. You need to have that initial conversation so that you understand how it works to get them to be able to come to me to be able to have that conversation with them. Make sense? So beyond that with clients, you know, really just offering some additional resources. Really, if you talk with a client and they're not in a position to buy right now, add value, find a way to add value. Say, hey, you know, right now, let's put you on a home buying plan. So they're working towards something, you know, whether it's they're setting up a family budget, or whether they're paying off debt, or whether they're saving for funds, whatever it is, you want to stay in contact with your people right now, because these are going to be the people buying, if they're not today, in the next 1 to 3 years. So if you have a CRM or you have a way that you're tracking, I would encourage you to set up a little box in your CRM that says, you know, contact when rates come back down, or some way that you can filter them so that you can make sure that hopefully you're reaching out to them along the way. But if not, you have a way to stay engaged with them as well. So any other questions? I know that was a lot of information. Yes.
So I just wondering, what's the projection of how high interest rates?
Yeah, so the question is the projection of interest rates and how high will they go? We don't know. I mean, it's just, like I said, I was a mortgage advisor and I'm on the top economist calls and they don't even know. I mean, we're hearing maybe even high 6s. Yeah.
What's our time frame looking at that in the next couple months?
I mean, recession is when we'll see rates come back down, which is in 1 to 3 years, is what they're anticipating. Yeah. Great question. Any other questions? No. So another thing that I wanted to kind of chat on too is Another, and we'll talk about objections that you may be seeing as, people putting in offers over asking price, right? That's a big one right now is people are really concerned and they're having to compete. I mean, I call on every single offer that's put in for my clients and I have a conversation with the listing agent. And it's rough out there still. I mean, it's multiple offers still. They're still over asking price. I have one today where we're having to put in the contract a $20,000 appraisal gap still in order for them to accept their offer. And it is something that can come into play where the appraisal is coming in lower. So we want to have those conversations with the clients, especially if it's not really going to impact them. So what I mean by that is that there's a lot of people that think that if the appraisal comes in low, I'm automatically going to have to bridge the gap. Meaning if the appraisal comes in $20,000 less than what I offer, not only am I going to have to come up with what Kristen told me I'm going to have to come up with, now I need to come out of pocket with additional $20,000. That is the case if they're only putting down the minimum. So if it's a 3% loan and they're putting 3%, yes, they're going to have to come up with $20,000 more because a lender will only lend on the appraised value or purchase price, whichever is less. Now, if they're putting down 5-10% and the minimum is only 3%, it may not even affect their payment very much. And they don't have to come out of pocket with money most of the time. So just make sure if that's a conversation that you're having with the client when you're writing an offer to reach out to myself or a lender. We can even do what's called a bid over ask, which is a calculator that shows based on that specific home. And we pull the information from the seller of how much their home is appreciated, whatever that percent is, how long it will take them to recover that gap. So if you have a client, they're like, oh, and you say, I think it's only going to appraise for X and it's 20,000 more that you may have to pay. You just put in that number and you put the $20,000 and it may only take 3 to 6 months for them to recover it. Meaning that based on the appreciation of what that home has done and where the appreciation is going, that it may only take 3 to 6 months to recover the cost. So it's a lot easier conversation for the client, especially when you say, hey, where are rates going to be in the next 3 to 6 months? If we wait, you're going to now pay more in a higher payment and you're still going to be where the home would have appreciated in 3 to 6 months, right? So having that information and having those tactics is really important. For those of you that know me, I love mortgage strategies. It's probably what I'm most passionate about, is figuring out a way that's going to make the client more successful and get the deal done. So if you ever have those one-offs or objections, always reach out to me. I want to make sure that you have the information and resources to do that. And we want to be able to show clients too, rent versus buy. A lot of people are like, I'm just going to wait for a year. Okay, well, why? Well, because I don't want to pay more for the home than what it's worth. Interestingly enough, if they're paying $2,000 to $3,000 for a rent payment right now, they're at the same. Because you show them, okay, in the next 2 to 3 years, how much did you pay for rent? And that's usually less than how much more they would have paid for the home, right? And they didn't lock in a price and their rent's going to adjust and all those factors too. I think people need somebody that they can trust, and integrity is very important. And I think that's where there's missed opportunity because we're not educated to be able to explain it to them. So that's why I'm passionate about learning all these tactics and having the tools and resources and the video and the education. Is I want you to be able to show them with true facts that you're not trying to sell them a home. It's not about you getting the commission. You really are showing them that this is a good financial decision for you to make. So if you have those objections, please let me know. I can always create some type of content. If you look on my social, you'll see I'm always putting marketing videos, all that kind of stuff that you're more than welcome to share all those as well. But is there any other objections or anything else that you want to go over today? I always want this to be of value to you. So if there's something that you're finding is, coming up, or something that you need more training with, or you feel that you need more support with, let me know. That's what these are for. I want this time to be worthy, because I'm a very big component. If you didn't walk away and there wasn't a tool or tactic or information that you got that isn't going to help your business, it was a waste of time. I don't want that. I don't like my time wasted, and I don't want your time wasted either. So let me know your feedback. Let me know what's going on out there so that I can help be a resource for you too.
So what happens with the value of a home?
Great question. I mean, then you're going to look at it and say, for somebody that's looking to buy a home and sell it in the next 2 years, they shouldn't buy. Cost to sell, they shouldn't buy. Maybe even 3 years. But for somebody that plans to be there more than 3 or 4 years, we all look at the levels of appreciation. Even during the worst market crash in 2008, we're already back over where appreciation levels are. I could show you the stats. If you look at every single 10 years of rate of appreciation, we've always had a positive level of appreciation. So should the market correct? If you ask me, I think it should. What's a correction? It just means 10% reduction in price. Because then it'll stabilize. It'll make it more affordable. But for somebody that plans on staying in the home anyways, it's kind of a non-mute situation, really, because how much would they waste it on rent? More than the 10% reduction.
Can you like touch base like on veterans, VA?
Yeah. What about VAs?
So just, you know, like I have my client and, you know, he loves this modular home. But like you were explaining yesterday, because it's a higher risk, that drops down his buying power.
Yeah.
By like 10,000.
Yeah, manufactured homes, any type of higher risk type property or transaction means higher rates because it's higher risk. So if you're looking at manufactured home, it's going to be a higher interest rate, which means that they're going to be able to qualify for less. But I do want to touch on something with VA since we're here, because a lot of people don't realize this too. VA, and I'm military housing certified, do a ton of VA. So with VA, two things that I want to make sure you're aware of that I'm finding in the market for my veterans right now, which makes me so frustrated that people aren't understanding it, because I feel like they're getting gypped out of an opportunity to buy a home sometimes. But with VA, if there's zero down requirements typically, unless they have entitlement that hasn't been restored, right? So zero down. So if you have a veteran, which is often the case where they're like, hey, I've saved $30,000 that I want to use as a down payment towards the home. Guess what you get to do? You get to write a $30,000 appraisal gap. Why? Because they can go to 100% of appraised value. So they can use whatever their down payment is on VA can be their appraisal gap on that home. So I have one right now where it was the same scenario that he was putting down 70,000. It's a VA. So we were able to he just did a 50,000 appraisal gap to give cushion, but he did a 50,000 appraisal gap, and that's how you get your offer accepted. Because if it's a conventional deal and they had the same client had that much money, they couldn't do that. So it actually makes their offer more competitive. Also with VA, you do not need a clear pest 1 and pest 2 section pest inspection on a VA loan if you can complete what's called a VA form that just says there's no active infestation. So if you have veteran borrowers, make sure that you reach out to myself to go over that when you're writing the contract. I talk to the listing agent and go over it with them all the time, because that's the big concern. It's like, well, we don't want to get a pest inspection now. There's all this work that needs to be done. Because on a standard, depending on who you talk to, a VA, they would say that it would require a pest inspection. All section 1 must be done, and possibly section 2. So for loan officers that don't understand VA, that's what they're still asking for, is why there's misinformation. But with VA, you don't have to provide a clear pest section 1 and section 2 if we can just have the pest inspector complete this form saying there's no active infestation, which typically is not an issue. And if there is an issue, then the buyer may not want to purchase that home anyhow. So good to know with the appraisal gap though. Also, if you want to make your offers, super competitive, make sure you're talking with the lender and ask, hey, how much of appraisal gap can I do on this home? And if your client's willing to work with it, if it's not going to change their payment, it's not going to change their terms, and it's $10,000 or $20,000, they're usually okay with it. And all the other lenders that are doing mortgage strategies like me are telling their agents to do that too. So as you have those offers, just call me. Let's go through the structure of it. I'm happy to help out any way that I can. Great question though.
So like for my client, the money is account. So would he be able to use that?
Once the money is funneled into his account and it's verified money, yes. But right now we're working on that with them. Yeah.
Cool.
Great question. Well, thank you guys for coming. I appreciate you being here. Like I said, I want to make sure that I'm being an offer of support. So if you have any questions or anything comes up, please reach out to me.